Hey guys, hope you're all doing alright and you're doing okay. In the last video, I explored the general direction that I'd like the channel to move towards. But in this video, I wanted to take the first step towards that general direction and kind of explain or explore a strategy that I've been working on for some time. And in this video, I just wanted to jump in, give you the whole entire model without any of the fluff, so that in the future, since I'm planning more videos, you can decide whether you want to be jumping in and exploring the reasons why we are taking certain actions or rather certain specific actions at specific points. In this case, I just wanted to cover the general steps for how you implement the strategy and when you need to, for instance, execute a trade, where you should be placing the stop loss and all that. This is the no fluff edition of this this is the no fluff edition of this series, where I just wanted to showcase what the strategy is about, how you enter, when you enter, and in the future I'll be exploring why we should be entering at those positions, why or how I essentially manage my trades, and how hedging essentially plays into the entire model. In this case, I just wanted to jump in so as to not waste any of your time, and so as to basically give you the essentials for implementing this approach. So just to jump in, the model itself is a divergence trading approach, whereby we use divergence based on the RSI indicator and comparing that with what the market is currently doing, and then we use that information to decide whether we have enough check boxes ticked to essentially take a specific trade in a specific direction. The model is based on a combination of two general concepts in the market, which is identifying structural levels, and it's based on I will call this an assumption for the time being, since there tends to be a lot of theories as to why the market moves in a specific approach or in a specific manner. So I'll just call this an assumption for the time being. So if we can all agree that the market moves from one point to another, and in most cases, if you've actually ever seen how people tend to draw the markets, you would find that people tend to draw the markets like this. So they state that the market would be moving in a specific direction. It would form specific areas where activity was it would form specific areas where it would pause, and in those specific areas it would tend to go back. So in this case, moving forward, I'll be referring to these areas as support and resistance areas, whereby once the market goes through a specific level, when it's heading down, it will be going through support areas, and then those support areas will be turning into resistance zones. In the future, maybe we can cover why I actually think the market moves like this, and we'll jump into that in the future. But for now, this is just a basic concept that the strategy is based on. So we are working under the assumption that once the market goes through any of these levels, which I will be referring to as significant levels or support and resistance levels, the market is likely to go back to the said levels and a reaction is expected. Now, in as far as the reaction that we'll be expecting, they're basically just two forms of reactions generally. So it's either the market will get to this zone and continue, essentially break the zone and continue higher if at all it's switched, or the market could essentially get to this zone and then reverse essentially, or continue in the initial direction. So given that assumption, we are working under the assumption that once it gets to those areas, momentum will start shifting, and the momentum changes or the behavior patterns of the market will be changing in these zones, and as the market is changing its momentum and its behavior, we should be able to take note of that change and take advantage of those situations, and in so doing determine when we should execute the trade, whether it's against the general direction of the trend or alongside the initial trend that the market was on. So to better explain this, assuming the market was heading lower, it gets to this point and it gives us a signal that it wants to continue lower. So it was reversing temporarily and now wants to continue lower. Once we get a signal for that, which we determine it based on momentum and the structure and the behavior, we therefore use this combination to essentially go lower. Now, you might be asking yourself, where does divergence play into all of this? So, in the model that I'm about to present to you, we use divergence as not as a signal, but as an indicator of market momentum dynamics shifting. So essentially, as the market is moving in a specific direction, you can observe that momentum using different indicators, or you can just use price action. I tend to prefer indicators since they're more precise. You're actually working with a specific number that you are currently viewing on the screen, and in so doing, you can determine the exact calculations of the momentum relative to the momentum that the market was moving in previously. So it's either bullish momentum or bearish momentum. And in those conditions, as one side is shifting, the indicator would essentially indicate that momentum is changing. And in so doing, if this momentum is changing in these specific zones and the market structure is aligned with that momentum shift, we therefore take a trade in line with what the market is indicating. So we essentially use divergence as a signal that the underlying dynamics of the market are changing, and then we use the market structure to determine when and how to enter the trades. So just to jump in so that I stop talking about this theoretically, we have several steps where we go through, in which we go through so that we can decide when and where we take trades. So the first step is to identify structural levels or areas in the market. So in this case, we're using a higher time frame so that we can then later on go down to a lower time frame and observe the minute changes in the market in as far as the momentum and structure is concerned. So in this case, as an example, I'll be using the 1 hour time frame. Once we've identified the structural levels, we wait for the price to approach those areas. So for now, let me just quickly shift to the chart so that I can elaborate better. So I haven't really gone through this chart, but I will choose an area at random where the market has been going, or rather the market has interacted with that area, and then we will compare. So I guess let's do maybe this area. So the market was here, and then it essentially broke past that level and headed lower. I hope you can see my annotations. So the market broke lower, and now we wait for it to go back to that zone. Essentially, I'm saying this is a level because it's evident that in the past, the market reacted to this level. As you can see, it got here and then started heading higher, got there again, reacted, and then ultimately it broke lower. There was something that happened here. So since the market reacted to this zone and we have multiple touch points, we therefore mark it as a zone. And this is just an example. As you can see, I just selected this area at random. For the purposes of clarity and being able to explore this further, I think I will be expanding this zone further so that you can, once we get to exploring it in the lower time frame, which the next steps will be elaborating, we shall see how the market will be reacting to this zone. So in this case, we wait for the price to approach the area, and once it approaches the area, we move to a lower time frame. That is step 3. In this case, I'm just using the 5-minute as an example, but you can use any combination of time frames. So we just jump to the 5-minute, and we will be observing these zones. Let me just mark them so that you can see. We'll check how the market reacted here, how it reacted here, because as you can see, it also approached the area there, and then all these other zones. So each time the market approaches that zone, essentially, we check how it behaved. We can of course also mark the lower area, but I don't want to jump into that for the time being. Let's just focus on the higher zone. I'll still mark it since it plays a role in as far as our targets are concerned, but for now we'll be focusing on the support that turned resistance. At this point it was support, but from here onwards it turns resistance. So let's jump to the 5-minute so that we can then explore the next steps of the model. So once we get to the 5-minute, remember, we are observing how the market is behaving as it is approaching this area and once it gets to that area. So based on our model, the next steps are to read the price structure. And in as far as structure is concerned, let me explain a few things, or rather just touch on them. So the goal is not trying to predict the direction of the market in as far as us trying to look at the structure. It is essentially to identify the locations where the reactions are likely to matter. As I mentioned initially on the chart, the market had reacted to this zone, and now we are anticipating that it might react again. We are not trying to predict that when it gets to that point, it will break out or it will reverse. Essentially, we just want to see how the market will react to that specific zone. So, as we did on the on the hourly time frame, we essentially marked the major support zones. We marked the major resistance, or rather we just selected one for the purposes of this example, and then these are mostly range highs and range lows, but over time, as you practice this, you'll get better at determining where the market is likely to react. And then you can also mark repeated rejection areas, as I did in the 1 hour time zone, and then you can essentially mark important breakout zones. So in as far as how you determine breakout zones, you can use your own definition, but in this case I'm just using a place where the market reacted before and we're anticipating that it might react again. Essentially, the main question that we ask ourselves is, if price reaches this location again, would buyers or sellers likely become interested? If the answer is yes, then we keep those levels. If the answer is no, then you can just disregard those levels. But at the end of the day, we want to always focus on these levels. Otherwise, as we are focusing on those levels, we just wait. So, in as far as the things we are checking for, in as far as the structure is concerned, once we get to those zones, we start checking for different elements. So, for instance, is the price compressing? Are there rejections? So are there rejection wicks and are they increasing? Are the pullbacks becoming weaker? Is continuation becoming difficult? Like, is the market getting to that point and then it is slowing down? As you can see, this move had way more momentum than this one. So you essentially study the structure and evaluate how the structure looks. Essentially, you ask yourself, is the structure healthy? If it was bullish moving to that point in both the 5-minute and the 1 hour, because remember, while the market broke below, it is now moving higher. Yes, it is going towards our level that we had marked, but right now, right this moment, the market is bullish. So that bullish trend, is it healthy? Is the structure deteriorating? Are we forming a lot of wicks as we are approaching that area? So those are the questions that you ask yourself. Remember, the price always receives priority over indicators. We are not placing, despite a majority of divergence strategies focusing on the indicator, this time we are focusing on the structure first, because the structure takes priority, and we just use the indicator as a extra confirmation factor. So once we are done evaluating the structure, we read the RSI structure. Now we move to the RSI. So before I jump into the points related to the RSI, let me just show you what the market was doing as it was approaching this level. As you can see, the market was initially very, very bullish here. It reacted very strongly to this level and started moving with a lot of momentum, in as far as my personal opinion is. You can see all these legs where the market is moving higher, it's moving with momentum. But then as you can see, as it is approaching this area, it's starting to get a bit more choppy. It starts getting choppy, but then it accelerates at this point. Gets to the our zone and then tanks, then tries to get to our zone again. This move has a lot of momentum too, and then moves lower. So you're essentially studying the structure and trying to evaluate, do we have a lot of wicks forming around this zone? As you can see here, wicks started forming, but then they aren't as many compared to this other leg. As you can see, we have more wicks here. Remember, if the market was at this point, we had not seen all this market structure. I'm just displaying everything so that you can see not only the behavior towards the level, the behavior after, and the next trial to essentially approach the area. So once we've finished evaluating the structure, of course, in the future videos, I'll be covering what exactly you need to evaluate and why you need to evaluate those specific elements. But for now, remember, this is the quick and dirty approach, or rather explanation of what the strategy is about. The next step is just evaluating the RSI. Remember, the RSI measures momentum, and in a future video, I'll be covering why we are using the RSI, why not the stochastic or the MACD, and what each of these indicators measure, and why the RSI is specifically well suited for this strategy. So keep a lookout for that. But in this case, we're just trying to evaluate the RSI once we get to this step. So once we arrive at that zone, we check the RSI and confirm whether the momentum is strengthening or weakening. Is the RSI gradually building up, or is it expanding with the price? Are divergences forming? And if the divergences are forming, are there multiple divergences towards the zone? So right now, as you can see, a divergence, I'm not actually sure if you guys know what a divergence is, but essentially divergences describe essentially showcase the market and indicators disagreeing. So essentially, let me give you an example. Assuming you're working with the RSI and the market was heading higher and it had formed a higher high. As you can see, this high is higher than this one. But then you notice your indicator instead doing this. So your indicator headed lower while the market headed higher. So if the indicator is measuring momentum, in this case, for instance, RSI, you will notice immediately that essentially the market bullish momentum, the buyers were able to push the market higher, but then bullish momentum dropped. Or you can also explain it as the buyers were able to push the market higher, but then selling or bearish momentum increased, leading to the RSI heading lower. So essentially, divergence describes situations where the price and an indicator, something that measures the underlying dynamics of the price, disagreeing. Because in most cases, if the price is going higher, the indicators are also expected to go higher. That's essentially what divergence is. And in this case, that's what I mean by checking whether divergences are occurring. So as an example, you can see that the market here is heading higher, but the RSI is heading lower around this zone. And you can see as the buyers were able to push the market higher, but the strength by which they were able to push the market higher significantly reduced in as far as the RSI is concerned. And after that, it dropped for a bit. But then it didn't go as far as we would have wanted. But then look at this. At this point, the RSI is definitely lower. But at this point, while the market was higher, the RSI agrees. So essentially, the price is saying that buyers increased and the RSI agrees. Regardless of that, the market still dropped. So as you can see already, divergence does not imply that the market must do what you want. And at times, divergences might not be there, but the market will still tank. That's lesson number one. It's not a foolproof way of determining that the market will go in a specific direction. However, you can use it as an indicator that the market is more likely to do one thing or the other. In this case, we can also compare the RSI at this level and at this level. When the buyers were able to push the market into the level, the RSI was at this point. But then when they got there again, despite making this whole entire show of strength to move towards the level, the RSI couldn't match up. The momentum by which they were able to push this, the strength by which they were able to do this, reduced despite them being able to form a higher high. We take this as a signal that the underlying dynamics of the market are changing despite what the price might be showing. So despite the buyers being able to push the market further or higher, their strength has significantly been reduced. Additionally, it could also imply that the sellers are essentially tanking or rather consuming all the buy orders that are pushing into this zone. Alternatively, the buyers might just be taking profit. So there are a lot of reasons which we'll be covering in future videos as to why this might happen. However, we just need to understand that we use that as a potential signal that the underlying dynamics of the market are changing. Once you observe that, you now start looking for an entry point. As you can see, in that zone, the market did that. The same would apply to other zones such as here. The market pushed into that zone, but the RSI didn't do as much. So it happened multiple times across this zone. And while you might have missed this one, since you were not able to put a check mark in your divergence checkbox, you would have still done that here and in the next zone. So let's just move to the next step, which is essentially the checklist. So initially we started by marking a structural zone, and in this case, yes, we are at a structural zone. And then we check whether the lower time frame structure supports the trade. In this case, the 5-minute does support the trade since we saw a lot of wicks moving while we were approaching that area. Additionally, RSI does support the trade since the RSI dropped in comparison to a previous high or a previous leg where the buyers were essentially able to push the market higher. Next, is there divergence? Yes, we've confirmed that with the RSI. And then, has structure confirmed the shift? Now, this is the important bit. This one and the next step. The next step is essentially managing your risk, but confirming the shift using structure. So, despite getting divergence here, we need something that confirms, okay, now we can enter. There are various models you can use to enter. In this case, one that I tend to use very often is to take an engulfing candle such as this. You essentially place your sell order there. Your sell order there. Your stop loss could go above the zone depending on your risk tolerance, and then you essentially target the lows. This is what I do often. But you can also change this to essentially account for the structure. The next example matches this well enough. Remember, by the time the market was doing this, all of this price action had not been printed. So in this case, the market makes a higher high, RSI makes a lower a lower high, we are at a significant zone, and then we get a signal, the market structure signal. Essentially, we get a doji candle engulfing following that, and then we can enter here. Additionally, you could also take this as a leg up. If you check this move, it looks like this. So you can wait for this zone to be broken, and then you can take the breakout candle, or you can wait for it to retest and take it at this zone. All of those are correct approaches to taking this trade. My favorite is to essentially use half risk at the initial zone, the initial engulfing candle, since that's like an early signal, and then once the market confirms the move by essentially breaking out, so for instance at this zone, you see the breakout here essentially failed, so I couldn't have added. But if you check this, we don't have a signal there. Let's see if we can get a signal elsewhere so that I can use that as an example. No signal there. Let's check the lows. Just want us to find one signal where the market is. I never really want to force trades, but essentially, let's look at this one. If you could have placed your stop loss at the top, you couldn't have been kicked out of this trade, but essentially you're just waiting. So once the market gives you a good enough structural shift, like here, I would add the next position. Essentially, I would risk half on this one and then half on the other one. Of course, I dislike trying to find the perfect examples in the market, since it essentially tricks the brain into thinking that all the entries are that perfect. But in this case, as you can see, we technically have a signal. It's just that it isn't perfect. And yeah, this is one of those occasions where a perfect signal would not have worked out. But that's the approach that I tend to use to enter. So you could either use half on the initial zone and then your stop loss above the support and resistance zone. You determine your risk, which is the last checklist. You can risk any amount. In most cases, I would risk between 1%, essentially 1% and above. I don't tend to place risk limits on my trades, since in most cases a trade might either be a grade A setup, and then I would risk way more, and in other situations I would risk way less. So for instance, if I want to risk 2% in my trade, I could risk 1% on this initial one, and once the market breaks out, I would add the additional 1%. So I would have 2% total, or maybe 0.5, 0.5, depending on your risk tolerance. That is for you to decide. But in this case, that's the model. Let me try and find a better example for you guys so that maybe we can use that as an example. Maybe this would have been a good one, because as you can see, the market was reacting to that zone, broke, and then came to this level. Hopefully that zone had a good enough signal. I'm just guessing at this point. Just wanted to show you that it's never always perfect, but as long as you properly manage your risk, everything should be fine. So as you can see, the market essentially broke this level and came back. When it came back the first time, let's check. We have this high, this one yet, it's at 73.89, and then we got higher to 74. So there is no divergence. And as you can see, while the market did try to form wicks, started to form wicks and indicated that there might be some weakness, it accelerated at this point, this huge bullish candle. So no entry, we just wait. But then again, once it got deeper into that level, because remember, your level is very subjective. It's based on how you are observing the market. The actual level might be slightly higher, so you still wait around there. Additionally, that is why I tend to recommend you draw rectangles as opposed to lines, since lines tend to beg or demand a certain level of accuracy towards the level that you're currently looking at. However, you might find that people have placed their stop losses and a lot of orders are essentially buckled, or rather jumbled around the level as opposed to at a specific line that you've drawn. So I tend to prefer rectangles, and in this case, as you can see, the market moved higher, and that's where it got its reaction. Let's check this critically. You can see the market here is moving higher in both zones. We formed a higher high, but if you check the RSI in this zone, it got lower. The RSI was heading lower. Additionally, try and check the candles as we are moving closer, or rather within this zone. We have a lot of wicks. The market would push higher with very large candles, but then immediately after they would be rejected. And actually in the future video I'll be covering this, but this is why I don't trust the candles alone, because as you can see, I can make the candles as large or as small as I would like, and since this whatever I'm doing is subjective, it could affect how you are trying to identify trading opportunities. In certain situations, you might find yourself trying to force a trade, and you would magnify the chart to make the candles look larger so that you can hopefully think, or rather lie to yourself, that the market has way more momentum than it does. That's why I tend to like to incorporate indicators, since regardless of how far you want to stretch your market to make candles look larger or smaller, it won't make a difference. The indicator essentially measures how this candle, its size, and the momentum that was involved in it relative to all the rest. So since it's an objective measure, of course dependent on your settings for the indicator, that's something that I can trust more than my subjective observations. Of course, I still need to observe the market dynamics, but in that case, I tend to depend on elements or aspects that are irrefutable. So for instance, saying that the market is reacting to this zone on the higher time frame, you notice that at a specific point, the market came to that zone, went back, came again, went back, broke down, and then it's now approaching the zone. So depending on how it's doing that approach, that's what matters. So as you can see, if you compare, for instance, this bearish move, there are a lot more bearish candles and they're strong with very few wicks compared to this move that is happening here. Some people would prefer drawing lines, but I'm not really a fan of those. But just know you can do that. Feel free to do it. But in this case, the thing that I wanted to highlight is that, as you can see, the market is forming a higher high and the RSI indicator is forming a lower low. And in this case, we have a signal. We've essentially checked all of the elements in our checklist apart from the risk element. And this is why you find me thinking I can take a smaller trade here, place the stop loss above, and then I would wait for the breakout. So in this case, let me first delete that and I'll show you the breakout. Could have also pushed this back so that you can see better. Good. So if you can remember, this is where our zone occurred. Sorry, I'm not really the best at trying to draw a lot on charts, but hope my explanation works. So in this case, that would be the first trade I would have placed. It's very low risk and I'm waiting for a confirmation signal. And then at this low, I'd be waiting for the break. If the market breaks below, now we know we are in a bearish regime, and I just place another trade at the close of that other move. In this case, you can structure your risk by essentially placing the stop loss above, but this is all dependent on how you like to manage your trades. After doing that, I just sit back and wait. In most cases, my exits are determined by getting an opposing signal from the market. So for instance, I would be observing this level very critically, because on the hourly, this is somewhere the market also reacted to. Remember, the market broke below, headed down, got to this point, and then headed higher. So we can essentially wait for a reaction at this zone to determine if we'll be exiting our sell trade. So in this case, as you can see, the market formed this low and then approached this low and formed a higher zone in the RSI. The RSI essentially formed a higher low while the market was heading lower. So essentially, in this case, what you could also decide to do is to exit both trades at the signal for the buy trade if you'd like. So we would have exited at that candle's close since it's an engulfing candle, and yeah, we've made whatever percentage depending on your risk, and then we jump into this trade. Did it lose? Yes, but this is where my next adaptation of this approach comes in, the hedging bit. There is an approach to hedging that I've developed that's intrinsically linked to this strategy and how I essentially like to trade, and I'll be covering that in a future video. But once you add hedging to this, the approach becomes really powerful and really adaptable, and it can just let you chill and wait for the market to essentially unravel, and you can continually add trades and build significant positions in the market. So in this case, this is where we're at, but I hope you understand the basic mechanics of the strategy. I'm of course working on documentation, a lot of documentation for you guys, and I'll be sharing those completely for free once they're all ready. So I'm essentially doing write-ups on why we are supposed to be entering at specific zones, why we're using the RSI as opposed to the MACD, stochastics, and other indicators, why we are using structure, and why we are also combining two different time frames to essentially account for the mishaps related to divergence trading and trying to observe the structure. Essentially, what I'm doing with this strategy is building one element and combining it with others to essentially account for each item's weaknesses. I know this video might not be as clear as you guys might want, but please feel free to drop down your questions and comments down below so that I can respond to them over time. Of course, please also expect that the PDFs will be covering this in much detail, since I might not have enough time to create videos for each and every question, but I hope to be able to address most of your questions. Otherwise, feel free to experiment with this, experiment with the idea, open up your charts, try to check whether this is something that you've observed, and yeah, don't forget to like, share, and subscribe to the video and the channel. Otherwise, thank you so much for the support, and yeah, see you next time.